Welcome to the Canadian Investors Course, Session 1, Short-Term Income Investing Commentary. Please note the terms of use and disclaimer, which, as before, will be at the beginning of every presentation. I'll only read the middle section as previously. The author of these videos and articles cannot assume any responsibility for what any viewer or reader might choose to do with this educational information. From time to time, the authors may express certain opinions in these videos or articles. An opinion is the interpretation of the facts at hand. The author of this video or article may or may not hold positions in any of the financial instruments discussed. Look at the cartoon on slide 3. There they are. Wall Street screaming for deregulation in 1980. Get the federal government off my back. Then, of course, in 2008, when they were in deep trouble, having caused all those problems, where's the government? Who's got my back now? Looking for bailouts. This isn't over. It's going to happen again. So, what are the three things we want to talk about in this commentary? We're going to talk about a company which got in trouble with its GICs, underscoring the importance of having CIDC insurance. We're going to talk about some definitions of CIPF and CIDC so that you're very clear on what those are. And then we're going to show you some charts which are going to give you cause for thought and will lead very nicely into why Session 2 on the bond market is probably one of the most important sessions in this whole course. So, very quickly looking at a company that got in trouble, Home Capital, darling of the markets, did really well, offered extremely competitive rates on GICs, and those GICs were backed by their high interest savings accounts, which were also very sought after. But suddenly there was a blip. People got scared. 1.6 billion were pulled out of its deposit base, which were the high interest savings accounts, because you can get that money out just by calling your broker or hitting a few keys on a keyboard, and boom, they were in big trouble. The company's been bailed out since. Warren Buffett got involved, made a pile of money on it, which is all wonderful, except the bottom line is the people that had those GICs for a few weeks, they wondered whether they were going to have any value left in those GICs at all. And by the way, if they didn't buy them through a IROC firm, there was no secondary market. And if they did buy them through an IROC firm, the secondary market had a huge bid-ask spread. In other words, if you wanted to sell your GIC, you were going to take a significant discount from what the full value was on that GIC. So anybody who had a larger than $100,000 holding in Home Capital GICs was very scared, and so they should have been. So now let's look at definitions. Canada Deposit Insurance Corporation, CIDC, we've talked about it over and over, founded in 1967 as a federal crown corporation. Insures up to $100,000 in case of bank failure. In other words, bank default. And to be eligible for deposit insurance, the deposits must be payable in Canada in Canadian dollars. In other words, US dollar and other foreign deposits are not covered. CIPF, what's that? Canadian Investor Protection Fund. It's a fund which protects clients of IROC firms against default of the holding firm. Specifically, the investments, first of all, are segregated. In other words, your investments, when you hold them in an account in an IROC firm, are held separately from the firm's capital. And secondly, they're covered by this CIPF insurance for up to $2 million per account against a default in the firm, creating a jeopardy for your account. In fact, what would happen if a firm were to fail is those accounts would be distributed amongst other CIDC firms, intact, segregated, and your money would be protected. Let's look at the charts. This chart shows the U.S. Treasury from the beginning of the 20th century until today. You can see that one could say that normal interest rates are probably somewhere in the 4 to 8% range. Today, they're not normal. They're close to zero. In 1982, they weren't normal either. They were over 20%, very briefly. If interest rates could climb to 20%, or 23% actually was the short-term rate in 1982, and now the short-term rate on Canada Savings Bond is probably 1% or less. Clearly, the only direction, since interest rates can't go negative, is either flat or up. If interest rates go up, bond prices fall. That's why you have to listen to session 2, because you'll learn what happens when that happens. Let's look at the Canada environment. Oh, chart looks almost the same. High interest rates in 1982, next to zero interest rates today. And what about the Fed funds rate? Next to zero again. Obviously can't go any lower. And what about Canada? Canada bank rate. Same thing again. Interest rates are very low. In a low interest rate environment, what's an income investor supposed to do? If you own bonds or debentures, or if you own bond funds, or if you own income and growth funds, or if you own some of those managed very conservative funds, or whatever they're called. In other words, if you own any kind of yield investments, you really need to understand the bond market and the implications for those components of your investments. And that's what you're going to learn in session 2. This is the end of the session 1 commentary. Thank you for listening, and we'll see you again in session 2.